Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Quinn Yuan. Today is Friday, December 5th. I'm Wong Peng Wei, and we'll be discussing a few topics. First, we'll talk about the significance of the More Threads IPO subscription agreement. Since 2026 is approaching, we'll also take a look at the investment outlook for EQ26 and changes in the market. All right, let's get started. This week, there are a lot of economic data releases today, but most of them will come out after the market opens. So for now, before the market opens, you can see that the major indexes are up slightly and most stocks are showing a tendency to rise. So now, the first data point we see is the September PCE. The expected value is 2.8, that's year over year, and the previous period was 2.7, so it's about the same. So overall, it's still quite high. For now, that's about it. For the month on month, it's 0.3, and the previous period was also 0.3, so 0.3 is still relatively high. If it matches expectations, that's okay for now, so we'll just have to see what the actual numbers turn out to be. So next up, for the year on year, the expectation is 2.8, which is a slight drop from the previous 2.9. The difference between 2.8 and 2.9 isn't that much, just a bit. As for the MA, the expectation is 0.2, which is about the same as before. So actually, at the moment, since this data is for September, and once it's quantified, this data is relatively important for the current wire market. For example, in the next 2 months, actually, at this point, the market probably won't react as strongly to this kind of news as it did before. So if the data matches expectations, it shouldn't have much of an impact. September's personal income will also be announced at 11 o'clock, with expectations at 0.3, which isn't too far from the previous 0.4. In addition, September's personal spending will also be released at 11, and it's expected to drop a bit, with the previous figure actually at 0.6%. The expected value is 0.3%, so we'll have to see if the actual numbers match the forecast. So these 2 data points there are quite a few reference values, so the significance of these micro-level figures for decision-making probably isn't that great. Next up is the December fabric, the Consumer Sentiment Index, which is a relatively important data point. The forecast is 52, while the previous value was 51. So this data is expected to show a trend throughout the second half of 2025. If it's 52 or 51, then there's still one more section left in the table below, which is divided into 2 sub-items. One is the current outlook or current situation with a forecast of 52 and the previous value at 51.1. It must be 52.1, and for the outlook, the forecast is 52.7 with the previous value at 51. So we'll have to see what the outlook is like at that time. But for now, since January from January to October, it's currently the peak season. So looking at it now, things should be relatively okay. Now let's look at the short, medium, and long-term inflation expectations. For the 1-year period, the forecast is 4.5, which is the same as the previous period. So for this, it's still okay for now. There hasn't been much change. All right, now let's take a look at the US dollar index. The dollar index is still maintaining a relatively volatile situation and is still showing a somewhat weak trend. However, you can actually see that the 2-year yield is showing signs of strengthening. So we'll have to watch and see if this will affect the stock market going forward. For now, it might be reflecting that the current liquidity is still pretty good. This situation is following yesterday's trend, along with the ongoing changes in jobless claims. At the same time, you can also see that the 10-year bond yield is showing a similar pattern, with a relatively clear deepening trend. The 30-year bond is showing the same trend. So actually, at the moment, government bond yields are deepening. Looking at the current situation, it seems that in the near term, there's relatively strong support. Growth is continuing, and overall, things are looking pretty good based on this interpretation. So actually, yesterday, the index was mixed with some ups and downs. The market took a relatively wait-and-see approach before the release of key data because, first of all, a lot of data was going to be announced. And even though it seems that a rate cut next week is pretty much a sure thing, but it doesn't look like there will be any significant, obvious big moves in the near term. Whether the market goes up or down, any major movement will probably wait until after the FOMC meeting. You might also remember that before September, actually, the daily fluctuations weren't that big, but it was only after the September FOMC around the 16th that the real upward trend started to show. Alright, so that's the current situation. As for the Dow, right now it also doesn't really have a clear direction, next to the Nasdaq, except for yesterday when it closed with a slight gain. And as for the Philly Semiconductor Index, actually, in the past few days, it was the index that went up the most, but yesterday there was a slight pullback, a bit of a dip, but overall it looked pretty mild. Looking ahead, if the market is going to regain its general upward momentum, then stocks in this sector should have quite a few opportunities to perform well. Alright, let's take another look. Actually, the performance of the CSI 2000 isn't that strong yet. Its index hasn't shown a clear, sustained upward trend. As for yesterday, the momentum in small cap stocks, these two factors showed clear performance, so we can see that there's an initial sign of sector rotation in the market. In a moment, we'll look at some individual stocks whose performance can confirm our current view. As for now, in terms of global developments, the US has informed Europe that by 2027, if Europe still hasn't taken over large-scale conventional defense capabilities for NATO by then, the US will stop some of its cooperation. This means the US is urging Europe to start increasing its defense efforts, and not just by spending money on military equipment, you also need to actually invest in combat readiness. And there are also some equipment upgrades, replacing old with new, and various hardware improvements and so on. So at the moment, actually, it seems that in the long run, construction and housing stocks will be a good opportunity for portfolio allocation. This is a relatively long-term opportunity, so there might be some gains, but they probably won't be huge. Everyone should weigh this for themselves. In addition, a few days ago, we mentioned that Belgium refused to use the EU's frozen Russian assets to help Ukraine, like giving them loans. Now, there's also news that the US actually lobbied various European countries to stop this from happening as well. Why is that? Because the US believes these assets should be used to help facilitate a peace agreement between both sides, not to prolong the war. So the US's position isn't about being brave or anything, it's just that they think the assets should be used for something else, not for this purpose. So militarily speaking, it actually looks like the war won't continue. This point of ours isn't really that important, but the reason the war hasn't ended yet is because things are stuck right here. Everyone has their own ideas, and everyone thinks they're right, so no one is really willing to make concessions. So right now, it seems like the US just wants to keep pushing Ukraine to see if maybe they can make some concessions so that this can end for now. But as for Ukraine, they're actually not willing to just end things hastily like this, as if they didn't gain anything. So it looks like this situation will continue for a while. On the other hand, regarding the market, as we mentioned, right now the market is basically in a wait-and-see mode, waiting for key economic data, and the volatility continues. Yesterday, there was some news that Kevin Hussein mentioned that next week, things will play out like this, roughly like this. So right now, Kevin Hart is very likely to be the next Fed chair, or at least the top candidate. When he said this, actually for the week after next, he basically confirmed it. And he also mentioned that in the past, when things played out like this, he expects that this path could lead to a significant drop. So at this point, the main thing to watch after this rate cut is how the path forward will look. As for next week, if the rate cut path remains as it is now, the market expects 2 rate cuts, and a range of 2 to 3 cuts would be reasonable. Next week, there will be an announcement. There will be forecasts for the economy, inflation, and employment. If these forecasts come out as expected without any surprises, it looks like the US stock market could kick off a new round of gains. If things move quickly, this rally could even start as soon as next week. As for Bank of America, they want to remind everyone that there are still risks at the moment, mainly pointing out that if the Fed's stance turns more dovish, what does that mean? It means they might think the economy is currently a bit sluggish, mainly due to the labor market. So next time, they might need to cut rates even more. Right now, the earliest possible rate cut is expected in March. That's what everyone is anticipating at the moment. Right. If there are voices calling for consecutive rate cuts, and those are coming from within the Fed, then people might think that things are actually worse than expected in the near term. In that case, it would signal an economic slowdown, and as a result, there could be a sell-off in the market. Rising interest rates would put pressure on the stock market. That could potentially put an end to the Christmas rally. However, if the current stance is either too hawkish or too dovish, we might see the same situation. If it's dovish, like we just mentioned, it means not worrying about inflation or the economy. If it's hawkish, it means not worrying about inflation. So right now, there are two possible directions. If they take a middle-of-the-road approach, not too much, not too little, and not too tough, then the rally should be able to continue. On another note, there was just news that Netflix might use its current stock price to acquire Warner Bros. As for what happens next, both companies are actually major players when it comes to university tuition fees, but Netflix is even bigger. Looking ahead, it seems that Netflix could become even more dominant. It could clearly take control of the streaming video and entertainment market, so we'll just have to watch how things develop from here. Next, let's look at the indicator for the real economy, which is the Dow Jones Transportation Average. Generally, if this index goes up, it means the real economy is doing pretty well. So, over these past few days and weeks, there's been a clear upward trend. The current rebound has even surpassed the highs from July and August. Judging from this, the fundamentals shouldn't be bad. As for the future, the economic slowdown might ease a bit, but we'll still have to see how things go next week. But our approach is to look for clues and hints from other sources, and then share those findings with everyone for reference. Now, about the financial spot. Regarding each investment bank's analysis, to sum up, right now, it might seem like the index is really high, especially for big players. But if we plot out the future forecasts, we realize the current index level isn't actually that high. That's because from the low point in April this year up to now, it really does feel like a big jump. And looking back now, it's definitely a significant change. But if we look at the current level and compare it to the projected points in the forecasts, there's actually still room to grow. So people often feel like the stock market is really high and wonder if people are afraid to enter the market and want to wait for it to drop. But sometimes we end up waiting a long time and never actually see that drop. In fact, the market is a lot like economic growth. It just keeps growing, and that's very likely to be the ongoing trend. So this is the current market situation and the direction it's likely to head in the future. First of all, let's talk about More Threads. This company was founded in 2020, so it's actually quite new. The founder previously served as a global vice president. Then the general manager for China, Zhang Zhenjiang, founded the company together with some of his colleagues. These colleagues didn't just come from Ziwei, but also from other tech companies like AMD and Intel. So what's special about this company? It's the only company in China that has achieved mass production and sales of fully functional GPUs. They started the IPO application process in June, and by October they had already received approval. It took just over 100 days, which is a very short timeline. Last year, for example, the average IPO process on the STAR market of the Shanghai Stock Exchange took about 470 days, which is more than a year. So the fact that this company went public in just half a year shows that the government is giving it strong support. So how is this company performing? Actually, it's still in the early learning stage. In the first half of this year, its revenue is about 700 million yuan, which includes the entire revenue from last year, but is still operating at a loss. It's expected that it could start turning a profit by 2027. On the other hand, there's another company related to Moore's Law information, which is quite impressive. This company had bank deposits of 2.88 billion yuan in the first half of the year, and it has plans to start making a profit for the first time this year. So, Moshi & Renji is still a relatively small company. In addition, in 2023, the United States put Moshi and Thread on the Entity List, which cut off its access to advanced process technology. As a result of this sanction, the company has already made some adjustments to respond to the changes in the geopolitical landscape. Later on, after learning from this, Moshi and Thread started preparing to go public, and this year successfully got listed. In addition, some people in China have established what they call the four little dragons of domestic companies. The other three companies, Moshi and Shares, Shuiwan Technology, and Vision Technology, are all planning to go public as well. There are all at different stages of going public, so it looks like after these companies get listed one after another, the Luokong stock market will have even more chip-related themes and targets for investment. Retail investors have been very enthusiastic in subscribing to these IPOs, with the winning rate being as low as about 0.04%. This company is fully benchmarking against Hwada, and from its founding up to now, its chips are updated once a year, and now there are already 4 major GPUs. Then, Lonjo said that NVIDIA also has the CUDA software, while More Threads asked for More Threads, it has the Mushar software. Basically, it's very similar to NVIDIA's development model. So as for the company, it wants to develop a fully functional GPU, meaning that this GPU can do many different things. With just one chip, it can handle AI computing, graphics rendering, physical simulation, video encoding and decoding, and so on. So this is a relatively general purpose development approach. Many Chinese AI companies focus on accelerating computing power, so in some ways it's a bit different. This is it's a much grander vision. Here's some details about More Threads products. You can see that they have different generations of GPUs, and also they also have corresponding graphics card modules, rectangular design devices, and various application areas. So at present, their offerings are actually quite complete, and after similar large-scale investments, there should be even more room for development in the future. But it's not easy. This company faces a lot of challenges because right now it has to take risks in R&D just to survive. From 2022 to the first half of 2025, the company lost 5.3 billion RMB, while its R&D investment reached 4.3 billion. So you can see that most of its money is being poured into research and development, which is also the reason why they're able to release a new generation every year. Concurrently, from 2022 to the first half of 2025, revenue was just 1.2 billion RMB, a relatively small amount. They're still facing a serious overall loss. As for this company, its clients are highly dependent on it. In fact, when a single client accounts for more than half of its revenue, it basically means it has one major client, and this major client is a government-supported patent center. Generally, its top 5 clients make up almost all of its revenue. Its revenue is concentrated. Essentially, it's selling to these few clients. Moreover, its profits mainly come from government policies. So this company still lags behind the leading players by several years or even decades. This gap is mainly reflected in computational precision, memory architecture, and some software aspects. Honestly, I think the differences are quite obvious across the board. However, at present, this also represents China's own chip industry, effort and determination. In addition, today we saw a news report that actually, when it comes to advanced chips from companies like NVIDIA or from the US, there has been yet another obstacle for their entry into China. Recently, this is what happened. To clarify, the CHIPS Act says that if you want to sell to other countries, you first have to meet the needs of the United States. Currently, this act no longer needs to be followed, but now, at this stage, lawmakers from both parties have introduced a new bill called the SAFE Act. Basically, this bill requires the Department of Commerce to suspend the sales licenses for chips to these so-called adversary countries. The suspension period is at least 30 months, which is more than 2 years, so it's actually quite a long time. Also, any high-performance AI chips would still need to obtain an export license. That includes companies like AMD and Google, so basically, it's comprehensive. If the goal is to ban AI chips from being exported to the US, then this measure actually seems to have a significant impact. One bill might be excluded, and then they look for another bill to ban chip imports into China. That's the current situation. So if this bill is really implemented in sync, it could be very effective. It would prohibit sales to China of products like the H200 or Blackwell. Right now, you can see that this situation is kind of like the maritime ban during the Ming Dynasty. It was just banned, no one could go out to sea. And everyone is well aware of the consequences that followed. So right now, the US is actually falling into a relatively self-imposed isolation. As for how things will develop in the future, we'll just have to wait and see. So what does the IPO of this ready-made company mean for us as investors? Today, its stock price surged 425% to 600.5 renminbi, making it the highest after Kweicha Moutai and Hainan Airlines weaponry, so it shot up a lot all at once. As for this company, it is also But actually, among newly listed companies with a market cap over $1 billion US, this one performed the best. So this means that the company was highly sought after during its IPO, and a lot of capital flowed in, causing its stock price to soar. The significance of this is that at present, if you look at the mainland Hong Kong stock indices and the performance of some individual stocks, they seem to lack clear direction. However, this hot topic and related policies, so the policies are very clear. If they are supportive, these companies will continue to be in high demand. This investment direction, in a way, is somewhat similar to what happened in the US when Trump was in office. That is, many companies are backed by the government and the government acts as a major player, but you never really know. It's just that you never know when they'll gain political favor. Sometimes the government suddenly decides to invest, while other times it's long-term support. So these will become a relatively clear investment direction in the current market. So what can we see from this? We all know that in the past, China operated under a nationwide system. Ever since its founding, the country has been state-led, with many 5-year strategic plans and a lot of long-term development. So there's continuity. In contrast, the United States is more like the government provides an environment that gives everyone commercial incentives and then lets things develop freely. So this business society is built on the will of individuals or companies to make money or simply survive. And then companies with more direct involvement, competition is inevitable. So there are certain market regulations and laws in place to protect their interests. As for now, China's nationwide system remains unchanged. But looking at the US now, as you mentioned, China is indeed on the rise and wants to emulate this nationwide system because it seems to be effective. So at present, it looks like China and the US are these two countries, which are clearly in a competitive relationship on the world stage, have both started to adopt the same system. So this means there will be a significant shift in direction going forward. In the future, analyzing market changes or making investments from a purely commercial, profit-driven, or financial perspective will become less and less viable. Many investments will become more closely tied to politics. Another point is that profits in the capital market may become concentrated in just a few companies. In other words, future investment opportunities will be hard to access in the market because you lack information. You don't know when these companies will rise, and you also don't know what government policies will be. So essentially, this market, this information, and the level of ambiguity, or let's say lack of transparency, has increased. This is something we're seeing as a shift in investment trends. We all know that right now, it's actually pretty hard to find stocks in the market that are clearly going to rise over the long term. A lot of times, stock rotations happen very quickly and prices change in the short term. So you have to move and adjust your pace even faster. And often, these stocks will show situations where prices spike or drop sharply. In the future, this could also happen in the US stock market, with trends becoming more like those in the Hong Kong market. In other words, fewer stocks will be worth holding long term, and more instances of rapid rises and falls. This means capital will rotate faster. So going forward, there should still be short-term and swing trading opportunities, but as we just discussed, the chance for huge long-term investment profits will likely decrease. Transparency will also decrease accordingly, so future market trends might become even harder to predict. That's the current situation. This is about more threads going public, and some of the things we can think of, as well as some viewpoints to discuss with everyone. Alright, next let's take a look at the investment outlook and market changes. In the current big picture, Trump is gradually starting to influence the Fed. In fact, once Trump is expected to announce who will be the Fed chair in the first half of next year, their statements in different settings, as well as their stance, will become very important. This situation is awesome. Currently, with the stock market crash coinciding with gradually declining interest rates, the market will improve. Right now, inflation is high and risky, but it's not a big problem and will be dealt with later. Overall, it looks like economic growth in futures will continue to drive the stock market upward. So what about the first quarter of next year? Or rather, the first half of next year is very likely to be a relatively golden period for investment, because during the election, there will be many side effects worldwide and a lot of stimulus, but those side effects haven't shown up yet. Then there will be a lot of welfare handouts, and the impact of tariffs will gradually diminish. The government will not intervene or will step back. At the same time, the first quarter of 2020 is still relatively far from 2027 or 2018, so there is still some hope for the future. People will still have some ideas about the future because, let's say by 2027, if everyone thinks the AI bubble has really burst, since we've seen constant investment but nothing substantial coming out, then that would really be the case. If the bubble reaches a more final stage, but for now we can still say, oh, we're still investing. And these applications, all applications take some time to develop, so there might still be this time lag. So we can still tell ourselves that there's still a chance, there's still a possibility. That's the kind of feeling. So this umbilical cord is the best stage. That's also why I think that the first quarter of next year, or the first half of next year, will be a relatively good period and stage for investing. The second possible outcome is that the stock market will start to rise, with information technology and communication seen as the main players on the side. As for Trump, earlier at the investment meeting, Mr. Fan mentioned Project 2025. This project actually has a shared agenda, and it's something they want to keep pushing forward. However, everyone first needs to be satisfied with his administration. Only then will he really be able to roll out and advance his agenda. So this kind of transition means the government needs to stay in power continuously to have the chance to do these things. Otherwise, there won't be any opportunity. That's why he has to get the economy in good shape first, so that people won't be too dissatisfied with the government, and only then will he have the chance to keep doing what he wants to do. All right, at the moment, the main risk of inflation comes from the possibility of inflation rising. If it goes above 3 twice and there continues to be an upward trend, then that's actually not good for the market. At that point, people might start to worry, and then it might be necessary to take some more profitable measures to prevent this from happening. Another issue is the question of independence. In fact, right now, the Fed is already facing questions about its independence, but for now, people are mostly turning a blind eye to it. As for what comes next, if the Fed's independence, if it loses its position, the consequences, as we've mentioned before, are actually quite hard to reverse. So that's one of the risks. The result could be faster and larger fluctuations with rapid rotations, but that's the situation going forward. So these are some risks for everyone to consider as a reference. So regarding research on the human body in terms of investment direction, actually in the international stock markets, it still looks like technology development is the main focus at the moment. Outside of the US, markets like South Korea and Taiwan are actually relatively good options. There could be more capital inflows and more opportunities for investment in these areas. So US technology is still a main focus, especially with AI, semiconductors, and energy leading the way. Looking ahead, there are also government policy-driven stocks, but key sectors include critical minerals and defense. Typically, during a strong bull market, small-cap stocks, real estate stocks, and non-essential consumer stocks also tend to perform very well. Today, we're going to focus on some individual stocks in AI, semiconductors, and energy. We'll list out these stocks, and as you can see, most of the gains over the past year have come from these names. So now, let's look at why these particular stocks. There's a chance they could continue to rise in the first quarter of next year. Right now, over the past few days, many companies have started to receive new ratings from U.S. brokerage firms. Prices have been raised, and there are plenty of optimistic reasons. Recently, you can also see that they've all dropped to a relatively similar level. They've pretty much fallen to a key support level. Now, it looks like some stocks are starting to see some inflow of funds, and it seems like this is a systematic entry of capital, because the gains across many companies are about the same. The gains are pretty similar, so it looks like, well, there will be the systematic inflow of capital, and then through social circles it spreads further. With the equalization of stock prices, it attracts more funds to flow in, and then a new wave of the market cycle can start again. We'll take a look at a lot of charts and talk dynamically about these companies' current situations and future outlooks. First of all, Google is actually still in a consolidation phase at the moment. It's the company with the highest investment certainty, and the environment is expected to keep improving going forward. As for Meta, it's currently back at its yearly moving average, so we'll have to see if it can change investors' perceptions of it. After the Metaverse index dropped, it's actually a relative positive for Meta. But still, Meta needs to come up with more effective and capital-light ways to advance AI. If it keeps borrowing money and making large-scale investments, then its stock price might continue to show relative weakness. As for Microsoft, its stock hasn't really shown much performance lately. You can also look at Amazon. It's also not performing particularly well since its stock price hasn't really gone up this year. Looking ahead, it seems likely to remain relatively weak as well. Ant Biotech actually has some opportunities coming up. Right now, the company is already transformed into something new. In the future, its main focus will likely be robotics. This area of development is a key point to look forward to, so going forward, more attention will be on its energy storage and the potential for robotics to really take off. As for Oracle, it's actually starting to climb above its annual moving average, and next week it will release its earnings report. Most people think that even if Oracle performs poorly, this is about as low as it will go. So actually, for now, Oracle should still be okay going forward, but you have a lot of other options, so it might be better to invest in these higher quality AI-related stocks, or to choose better investment directions. As for BRT, it's a major beneficiary in the manufacturing sector, but its share of spending in treatment centers is still relatively small. However, it's one of the biggest players in the late stage. The company is expected to continue to rise steadily in the future. As for LIT, given its current sharp increase, everyone can wait for it to pull back to an important moving average. Because if you look at the stock's past performance, it tends to surge, then pull back, take a break, and then surge again. So everyone should pay attention to the chart patterns and act accordingly. As for Celestica right now, it still seems to be in a bit of a tug-of-war, and the bulls haven't shown a clear breakout yet. Since there hasn't been a breakout, it might be best to wait a bit longer. Looking at it, the current volatility seems to be temporary. There should still be a good chance for another upward move in the next wave. So, recently, it has actually seen a noticeable rebound, especially yesterday. As for what comes next, actually, because the manufacturing process is still quite extensive, it's still one of the biggest beneficiaries and companies that will profit from this, so that's a huge point of anticipation going forward. Also, this company tends to have relatively large price swings when it rises. Companies like Seagate and Western Digital also have opportunities for gradual gains in the future. However, for these two companies, their potential for further increases might be relatively limited since they've already seen significant gains in the past and the capital has been sustained for quite a while. As for Q, going forward, it should still be an important beneficiary within the treatment center itself. Since the stock price is quite volatile, everyone should pay extra attention. At this time, it's mainly about scaling out, as well as being a key player in long-distance ECI deployment. You can see that its decline in January wasn't significant, so in the later stages, I think it could still have another run. As for Caterpillar, it actually has two segments. One is industrial, and the other is within the manufacturing center. That's why you see industrial stocks performing relatively strongly, because they have both attributes. It's also a Dow Jones component stock, so I'm curious about what comes next. Yeah, it should still be pretty good. The stock price is relatively high, but it's worth keeping an eye on. As for CallWave, it's actually started to show a clear rebound, but the key is to judge how far it can bounce back. For now, the outlook should be relatively conservative because this company is capital intensive. They have to spend money to build these things and then rent them out to others. And the supporting materials are also provided by this company. So going forward, this company will probably face some pressure in the future. As Nephew said, it's like a flavor. On one hand, it has a more efficient cost structure, and on the other hand, it has other side businesses of its own. The company's revenue is growing and its business is diversified, so this company has even more opportunities going forward. And then overall, its operations. Its presence also spans across the US and Europe, which actually adds some extra points. As for iWill, it does seem to have room for further growth, but at the moment the company is under quite a bit of pressure, so it still needs to keep investing in order to make progress, to be able to provide more services in the future. So for now, actually, everyone might be. So it's best to take advantage of this wave of market movement, but it's not really a stock suitable for long-term holding. APLD is in a similar situation, and since its stock price is even lower, the volatility is even greater. As for PLTR, it's actually relatively weak at the moment, but going forward, it should be able to gradually rise. As for PLTYTR, its current situation is more like a fully owned stock, so everyone knows it's pretty good. And a lot of the expectations for its future have already been priced in, so there probably won't be much change going forward. This stock might just become a relatively stable long-term investment target. The company itself is pretty good, and it's also a major player in AI applications. The company is doing well, so going forward it should be able to continue to rise steadily and then have another round of market movement. Path has gone up quite a bit recently, especially yesterday, and there was no break yesterday. As for what to do next, just keep an eye on it. I'll take a break and then wait and see. As for this app, Loving, we mentioned before that its performance has been pretty good. It actually went through a round of correction, but now it's quickly and steadily climbing back up. For this company, actually, right now, its fundamentals are quite good and it's very profitable. It's also involved in social AI, so this is a company everyone should really keep an eye on. It's one of those companies that could see a significant surge in the future. Plus, even though the stock price is already pretty high, there's still a chance it could keep hitting new highs. As for ND, after the recent gap up, it's been consolidating. It might need to consolidate for a while longer, just like it did before, so in this case, you could make corresponding moves. And pay more attention as the technical chart develops. As for Shopify, it's actually one of the major companies currently applying AI. Going forward, this company should perform pretty well. Right now, since November, its stock has shown a clear rebound, and it should continue to rebound in the future. As for IonQ, honestly, when it comes to quantum, it's not really clear how to categorize it, so for now, let's just put it under AI. Actually, quantum is a long-term trend, meaning that before quantum technology truly develops and we see who comes out on top, that's when we'll really know who the ultimate winner in quantum will be. Since it's not fully developed yet, small companies have just as much opportunity as big ones. These smaller companies can land a lot of partnerships, sign many MOUs, or achieve various technical breakthroughs, and that gives their stock prices plenty of chances to perform well. So that's basically the current situation. Going forward, IonQ will likely remain highly volatile, which means there are short-term opportunities for everyone to take advantage of. As for RGTX, if we look at it in the context of quantum, we can see that recently there's been a steady inflow of capital. The stock's price increase is quite noticeable, and you can tell that capital is moving in early. But this is just the first and second wave, so going forward, we'll have to see if the upward trend continues. If it consolidates here for a bit, it wouldn't be too surprising if it spends a little more time at this level. As for Huida, right now it's actually facing a lot of negative factors. It's a bit mixed, but at the moment, the main thing is just what other people have said on the show is that as long as Huida doesn't drop, and if it consolidates here, that's actually a pretty decent situation. As for MD going forward, it's also a company with relative potential, and right now the stock market isn't really falling either. As for Broadcom, they're releasing their earnings report next week, and it's actually expected to perform very well. In fact, right now, Broadcom's outlook is better than both NVIDIA and AMD. Currently, it's the best company in chip manufacturing and design. If the outlook isn't too narrow, I think it should be able to gradually rise in the future. As for Intel, it's pretty clear that in the short term, it has an overheated situation, followed by a drop, but there should still be clear room for an upward move afterward. As for desktop chips, they're actually rising slowly and steadily. Micron, on the other hand, has been steadily climbing recently, but it looks like it might take a short break before going up again, or it could just keep rising. We'll have to see. If it's like this, then right now, or at this stage, some stocks have already risen very quickly, so for those, if you want to catch these opportunities, there's really no need to rush. Just wait for a pullback and then wait for another chance to get in. At the moment, KLA seems to be steadily rising. NVIDIA, on the other hand, is in a different situation. As for Lam Research and other equipment stocks, like we talked about yesterday, it looks like they have multiple growth cycles. First, the shift is happening with AI adoption, and in the future, there will still be room for consumer batteries to be adopted. Since the adoption of consumer batteries hasn't really arrived yet, this is a long-term structural change. The corresponding companies are ASML and then Henninger. Actually, these companies will have even more opportunities in the future, even if they're already performing well now. Next, let's take a look at the meta stocks. For meta stocks, you can see that GEV has finally shown a clear case of capital rotation and precision. In the past few days, or rather the past few weeks, the capital flow is very unclear. As for GDP, it has been consolidating all along, but now it seems to have a relatively clear breakout. We'll have to see if this breakout can be sustained. Another one is B1. For B1, you can see that this company is actually quite suitable for everyone, as it offers these kinds of swing trading opportunities. Its fluctuations are always quite large. The volatility is high, and on top of that, the company's outlook is very good. So basically, if you notice that this company has some obvious drops, you can keep an eye on it and consider making some arrangements. As for USA, it's actually the same situation. There will be a clear need for long-term handling in the future. Even if the company's current fundamentals aren't that great, it still means that capital's hyping it up. So this is the first power generation company. It seems to have a clear, stable, and steadily rising trend, which makes it more of a long-term play. This is a company suitable for long-term holding. As for OK, it's actually also a leading nuclear energy concept stock, but right now it's still in the PPT stage, basically just a company on paper. But the government supports it, so it's basically a company that rides the waves of market trends, kind of like what I mentioned earlier. The situation is similar to SE. As for B1, it actually has some real technology, so OK is even earlier stage than USC because it hasn't really been put into practice yet. So for OK, it's actually it's a high-risk target, but with high risk comes the opportunity for high returns, so everyone should weigh it for themselves. As for LEU, it looks like it will continue to rise in the future, because after all, its position in the industry is quite clear. It basically has a near monopoly status, so it seems like in North America, it's the main supplier. Next, let's take a look at some key stocks. We're talking about MP. For MP, right now, it seems like it's stabilizing at the bottom, so it should be fine going forward, and there will be quite a bit of control. The current pre-market rise is mainly because brokerage firms have raised their target price, so you can see that at the moment, that's basically the situation. In the US stock market, after it goes up for a while, it'll start to fall. After it drops, if it goes up again, it's usually because some funds get in early, then brokerages raise their target prices, and then it starts to rise again. The first wave of gains is actually pretty clear. After today's increase, more funds gradually flow in, so it looks like the whole thing is just a cycle that keeps repeating itself. The cycle just keeps going. It's the same with optimization. Basically, the whole sector starts to see some funds coming in repeatedly, and the stock price forms a base, which looks like it's almost done or close to being completed. Similarly, ARAC, American Resources, and others are showing the same pattern. Here you can see that actually MATC and also ARC, when you look at their trends, they're relatively weaker within MATC, but in this area, you can focus on keeping the strong and eliminating the weak, and then look for opportunities. Look for targets that have more momentum and are attracting more capital. As for T&Q, it's a company that the US government has invested in, but recently, honestly, it seems like there hasn't been any special performance, even though it's government-backed. This is a government-backed stock, but it doesn't seem to have notable performance. It looks like it's already priced in. All right, now let's look at the pre-market strong and weak performers. So overall right now, most stocks are still up in pre-market trading. This one is a healthcare company, and its outlook is pretty good. And then Yatry is also raising their outlook. And they mentioned that actually Oracle, and then Eaton, as well as Roten, Clayton Core, Teradyne, and also Microchip. Actually, all of them. Yeah, most of the mainstream tech companies are up in pre-market trading, so things are looking relatively okay right now. Of course, there's also Intel, KLA, JEV, and so on. WBC too. The overall situation looks pretty good. Now, looking at the stocks that are down, the main reason is HPE. It's not looking good, and as for Netflix, usually the acquirer stock will drop at first. Let's take a look at the volume. Most of the stocks I just mentioned are actually trending up, so right now it looks like the pre-market is seeing a slight increase. Then we'll wait for the major economic data, and depending on how that data comes out, it'll affect what happens next. And also the direction of the stock indices in different countries' markets. Looking at the overall indices here, you can see actually a lot of small cap stocks are showing a pretty clear upward trend, which also indicates that risk appetite is making a comeback. There are also quite a few that are down, so it looks like this could be due to specific factors affecting certain companies, and just now we were talking about some earnings reports. Since many individual stocks went up quite a bit yesterday, they're showing a decline in pre-market trading right now. We'll have to see if this situation continues after the market officially opens. For example, RGTI or OKLOK, since they're raising funds, their prices are dropping. As for others, like those raising funds, right now in pre-market trading, we're seeing some small gains and small losses. The mainstream tech stocks are showing more obvious trends. Most of them are up, but a lot of the newly listed stocks that surged yesterday are relatively weaker in pre-market trading. Overall, looking at the market now, the outlook still seems it's more likely that there will be a broad rally after the FMC. Although there are still quite a few risks at the moment, everyone should pay close attention when going long, and the pace and rotation might pick up even more. That's all for tonight's experience sharing group. Thank you all for watching.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.